Okay, so completing the accounting cycle, all this while, chapters 1 all the way through now 4, you've been basically doing the accounting cycle as you go through. And this is the last final part of the accounting cycle, which is to make closing entries and do a post-closing trial balance. So, benefits of a worksheet. A worksheet is not something that you have already or you've not seen before. You've actually been doing different parts of the worksheet. You just haven't done it all combined together. So it's going to help whoever is preparing financial statements to prepare them more efficiently and quicker. It's going to reduce any possibilities of errors. It's going to link all adjustments that have to be made. It's going to help whoever is planning to do those things properly. And the worksheet itself is not what is being recorded. It's just a tool that's being used. So this is typically what it looks like. And like I said, you've been doing pieces of it. So far, chapter 3, you learned how to do the unadjusted trial balance, then the adjusting entries, and then the adjusted trial balance, and then you can prepare your financial statements, right? They've given us some adjustments here to kind of look at, and I'm going to annotate over them as we read through them. Okay, so for instance, it says down here at the bottom, the company has earned $9,000 in fees that were not yet recorded at year end. So they earned it, which means we classify it as what? Revenue. And they were not recorded. It didn't tell you that they received cash for it, so we have to assume that it is a what?
Accounts receivable.
Accounts receivable. So what adjustments do we make in these two columns here? Just for letter A.
Fees earned.
Fees earned, are we going to put it on the debit side or the credit side? Did it increase or decrease?
It increased.
Increase. So what side do I put it on?
Debit.
Debit?
Yeah. Credit.
Credit. It's that's revenue. It increased by 9,000, right? Because it said they hadn't recorded it yet. And then where else did we put that 9,000?
Accounts receivable on the debit side.
Okay, accounts receivable on the debit side. That's that one, right? Next, the company incurred $2,000 in salary expense that was not yet recorded. So what two accounts are affected here? Salary expense and cash. So what do we do with cash? Does it increase or decrease?
Decrease.
Well, actually, no, not cash, because they didn't say anything about cash, did they? So what did they say? They just said that they incurred that salaries expense. So it's salaries expense and what else?
Accounts payable.
Accounts payable, because they said here in the hint, for simplicity, assume it records any salary not yet paid as a part of accounts payable, right? So salaries expense, does it increase or decrease by 2,000?
It increases.
Increases, so we put it on the debit side for 2,000, and accounts payable increases or decreases?
It increases.
Increases, because it must be paid, right?
2,000 on the credit side.
2,000 on the credit side, good. And then the last one, the long-term notes payable was issued on December 31st this year. Thus, no interest has yet accrued on this loan. So what happens?
0 to interest payable.
Well, nothing happens, right? Because it said that nothing had accrued. So now that we've made these adjustments, we need to pull everything over to this adjusted column, right? So cash, did anything change?
No.
No, so I can do 13,000 here. What about accounts receivable?
$1,000.
$1,000.
9,000 had increased.
It increased by 9,000, so that means 9,000 plus, right?
1,700.
17,000.
Yeah, 2,000.
Land,
85,000.
85,000. It didn't change, right? Accounts payable,
12,000.
12,000 on the credit side. Notes payable,
33,000.
capital,
Debit 20,000.
withdrawals.
40,000. That's on the left side.
So it goes on the
Wait, yeah, withdrawals always increase in the debit, right?
So 20,000 on the debit side. And then fees earned,
79,000.
79,000. Salaries expense,
56,000 on the debit side.
office supplies, 8,000. So can you tell me the totals for these two? For both columns? $199,000.
The 79, it balances.
Okay. So we balance on both sides, which is great, right? Now, what part of these go on the income statement? What goes on the income statement?
Revenue.
Revenues and expenses. So over here, I can bypass all of this, right? And come down here to fees earned. Yeah.
Yes.
And 79,000 there. The expenses,
56 and 8,000.
now if I subtract these from here, I should get a net income of what? 79,000 minus 56,000 and minus 8,000.
15,000.
What goes on the balance sheet?
The
Assets, liabilities, and equity. So I can just bring these things over, right?
13,000.
Assets were 13,000, 17,000, 85,000, right? That's all for the assets, right? Liabilities, 12,000, 33,000, 75,000. Is that all? Mm. Withdrawals, right? So all the assets total what? Because that's what we're gonna put on this side here for totals. 13,000 plus 17,000 plus 85,000 equals what? How much? 13 plus 17 plus 85.
That was that fast. You said 13 plus 17
Plus 85,000.
Not plus the 20?
20 is withdrawals.
Oh.
So how much is it?
115.
115,000. And then our liabilities, 12,000 plus 33,000 plus 75,000 minus 20,000. Because that's minus your withdrawals. Uh-oh. 12,000 plus 33,000 plus 75,000 minus 20,000.
Mm-hmm. I had 100,000 too.
100,000?
Yes.
So did you add something here wrong? Because they're supposed to equal. Yes. 13,000 plus 17,000 plus 85,000.
Yeah,
And
so
then-
we did something else wrong.
12,000 plus 33,000 plus 75,000.
Well, you can see there's a difference, just a much less. Yep.
Yeah, we did.
Okay, well, let's figure it out.
There was $500 difference.
That was correct. Right?
You got it, right?
Good so far.
Uh-huh.
They added 20.
They added.
Mm-mm,
They did,
mm-mm.
because that's what we originally.
You're missing this line. Net income. Remember the statement of owner's equity? Beginning capital plus net income minus withdrawals. That's what these two columns are for. Balance sheet and statement of owner's equity.
Yeah, so what we're saying is, you see where
They didn't add the 20. Again, add these, then also add net income here and subtract withdrawals to get the 135.
so why is that total say 135?
It is 135, but what is the statement of owner's equity
okay.
process?
I'm just getting confused because it's not, the 15's not, no, but,
The 15 is net income,
yeah, but the net
but you
income
gotta
isn't-
incorporate that.
Right, but we don't take that into consideration, but on the credit side, right? On the debit
You
side.
do. You take consideration of it, period, because eventually this is being subtracted, right? No?
But where they get the 135
On the debit side.
That's fine that they got
total.
the 135 the way, what I'm trying to get you to see is these are two statements put together in two columns. That's what I want you to see.
Right.
And I want you to also see, we did the balance sheet first, and then the statement of owner's equity is beginning capital plus net income minus withdrawals to get ending capital. You understand? They just put it in two columns. And if it makes it easier for you, add all this, then add all that, just don't forget net income in the process.
Okay. Much more confusing looking at it all together.
But that's the part that may stand in between you getting a problem right on your homework. Because that's how the worksheet actually looks and should look.
So I got a question. So the net, when you did the net income, you subtracted, the credit side of owner's equity? And.
Not subtracted. How does the statement of owner's equity go?
You added the credit side of owner's equity, but you subtracted the
Withdrawals,
20,000 from it? And that gives you the net income?
135, no,
It doesn't give you 135. Because 12,000 versus 75,000 equals to 120.
I see what you guys are doing.
Okay.
And you're trying to make it simple for yourself, but you ain't doing it the right way. You doing all this. Just add everything. I need you to understand how they got there. I don't care what you add, what you subtract, it's how you got there. Ultimately, if we didn't have these two columns and I had to do two different statements, a balance sheet and a statement of owner's equity, first of all, out of the two statements, which one comes first? Which one do you prepare first?
The balance sheet.
The owner's
That's why you're confused. It's the statement of owner's equity that you prepare first. You cannot get to the ending capital balance if you don't prepare the statement of owner's equity first.
Okay.
Statement of owner's equity says beginning capital plus what?
Plus net income.
plus net income minus what?
Owner's
Withdrawal.
Withdrawals equals what?
Equity.
Equals ending capital, right?
Yes.
So looking at this, it's all well and fine to add both columns if that's what you feel comfortable with doing, but when you go to do those two statements and you're saying, I don't understand what I need to do, that's where the problem comes in. So we know how to get to ending capital? No? Who said no? Yes? Do we know where net income came from?
The income statement. That's your two columns right there.
Statement.
That's basically the income statement, right? Revenues minus
It's
expenses. This is just showing you the adjusting journal entries that would normally be made before you put them in that adjusting column, bless you. These are all the statements to be prepared from that worksheet, which is routing you, showing you where those numbers came from, right? Closing process, this is what I need you to write down. It's 4 steps to the closing process. What you're doing in the closing process is that you're closing out all temporary accounts so that only the permanent accounts remain. So here they're showing you reset revenues and expenses and withdrawals accounts to 0 at the end of the period, and use the income summary account. So the first thing you need to write down is income summary is a contra clearing account. Income summary is a clearing account. And the question normally is, well, what are we clearing? We are closing out temporary accounts and we're keeping all the permanent accounts. So we're closing out temporary accounts to 0. So the income summary account is a clearing account. And I'll show you in a minute how that's used.
You wanna write the other part down. Just that clears.
This income summary. And so here it is. We close out these temporary accounts. Clearing the income summary is a clearing account, and it's also temporary because we don't keep it for long. We use it just long enough to close out the temporary accounts, and then we close it out as well. So these are the temporary accounts. These are the ones we should be left with after we do our closing journal entries. Okay? So temporary accounts are revenues, expenses, withdrawals, and income summary. And then permanent accounts that will be left will be your assets, your liabilities, and your owner's capital. I'll give you a minute to write that. It's up here on the board. Temporary accounts, permanent accounts. And I'm not quite sure if this figure itself is in your book. It is? Okay.
Can I ask a side question?
Yes, ma'am.
As far as when, as far as like owner's capital, like if you have investors, is that something separate?
Whatever owner, if they're an owner of the business, whatever they invest is considered capital. But if they're an investor, meaning they own no portion of the company, that's not the same.
Okay.
No, that's not the same.
So anybody who has equity, their capital will go into owner's capital.
If they're an owner. If they're not an owner, it can't be considered owner's capital.
But if they have equity, that automatically makes them an owner, right?
If they're a portion, yeah, if they have a portion of the company, so if they own maybe 10% of it, they're considered an owner. But if they own nothing in the company and they just
Invest
pay
in
money,
it, then it's like a long-term note or something.
right.
Okay. Okay.
she asked the question of whether or not anybody who invests in a company, would that be considered capital, and it's not. Because if they are not specified as an actual owner, then no. So just because you invest in a company does not mean that you are an owner. So you have to have a certain percentage of stake in the company to be considered owner.
So that's something I need to sit on the table with, something that has to be written.
Say it again.
Is that something that is understood, or does that have to be written?
Depends on the business.
Oh, okay.
Yeah, depends on the business, on how they work it out. Okay, so recording closing entries, you got 4 steps. We close revenue accounts to income summary, we close expense accounts to income summary, then we close income summary to capital, and then we close withdrawals to capital. So this is the part that is important. This is step 1. Step 2. Step 3. Step 4.
Is this gonna be saved when I can clean it up?
Yeah, you can watch the video again, but it won't be by actual print. So
Oh, okay. Just write it down.
you can write it down, or the PowerPoints are in the class in that same
I
folder.
take a picture.
That's not trying to, right, so you can't, those PowerPoints we trying, we can't print?
You can print them. They won't have my marks on them, is
Yeah,
what
that's
she was
right.
asking.
Yeah.
Blue side, don't stand that way. And so this is what happens at the end of whatever the
End of the accounting period. When you're closing out the books for the accounting period, this is the process you have to go through to do the closing entry. So this is a part of the closing process. Does everybody have this?
No.
One more second.
Okay. You guys got it? So let's look at this example they have here. They've given us a trial balance, and this has clearly been adjusted So we need to do closing entries. Okay? So step one, what's the first step in the closing process that you wrote down?
Revenue accounts and income summary.
Close revenue to income summary. So something that you guys need to know, anytime you're closing an account, you have to do the opposite of whatever the normal balance is. So for instance, if we're closing revenue, what's the normal side of revenue? Normal balance. Credit. So to close it, we gotta do what? Debit. If, expenses, what's the normal side of expenses? Debit, so that means we gotta do what? Credit, and that is, by the way, the only time expenses are credited, is through the closing process. Okay? So, if the first step is to close revenues to income summary, and we always do this at the end of the period, so I'm just gonna say 12/31. What do I debit and what do I credit to close out revenue?
To
Close out the revenue account to income summary.
fees earned, you're going to debit 79.
So fees earned, 79,000 in that account, right? And what do we credit? What is it? Income summary. That's the clearing account, right? And write this down as we go along so that you'll be aware of how this actually goes. So now, after we've done this, we can honestly say revenue is what? Closed and equals 0. Okay?
Quick question, so when you, on everything that you're gonna do, concerning revenue, it would, all of them would come under the, income summary?
Not concerning revenue, everything that we do concerning the closing process.
Right, I'm sorry, yeah.
Not everything, but when you're closing out revenue and you're closing out expenses, they all go into income summary.
So income summary will become what you would.
What did I say it was? What did I call it?
Clothing?
A clearing.
Okay.
You know how you clear things down to 0?
Right,
That's what we're using it for.
okay,
So we're just plopping it in that account temporarily, and then we're gonna close that account itself as well.
Okay.
What's the next step? This was step 1.
Debit expense accounts. to
Close
income.
expenses. So we have 2 expenses up there, right? And you gotta do the opposite in order to close it.
No, credit them.
So we debit what first?
Income statement.
Income summary.
What?
Yeah, you're doing it.
Oh, the debit still first.
Yeah.
Okay.
Debit income summary. Credit what?
Credit salary
expenses,
office expenses.
Salaries expense, 56,000. Office supplies expense, 8,000, which means income summary is how much?
$64,000.
So now we can honestly say what? Expenses are closed, right? They equal 0. What else does this signify just from you looking at it? If you looked at what we did here and what we did here, and you know now the income summary account has a total balance of what now? Started off with a credit, right? Then we did what? If you take these 2 here and subtract, it equals what? Which also equals what?
Net income.
Net income. Alright? So now, step 3 is to do what?
Close because some of the accounts are on capital.
So we have to do what? I told you the normal side of income summary is what?
Of income summary?
It's credit.
It's credit. So you gotta
It's credit. So you gotta debit it in order to close it, right? So, we're gonna debit income summary and credit what? Yep.
Capital.
Capital. And what amount?
75.
We just talked about it. 15,000. Because that's what's in there, right?
Right.
79 minus 64 it equal 15,000. So that's what we're closing into capital. So we can honestly say now what is closed?
Income summary.
Income summary is closed to 0. And that was step 3. Step 4.
Close withdrawals to honor capital.
So what's the journal entry to close withdrawals? You got to do the opposite to close it. And if the normal side of withdrawals is debit,
So you got a credit.
you got to credit withdrawals and debit what? Think about what you're doing. Capital, because you're closing withdrawals to capital. So you're going to credit capital, debit withdrawals. What amount? 20,000, right? And after doing that, we can honestly say what? Not capital. Close to 0. That's step 4. Now, we should be able to figure out how much is in capital now, right? Because it started off with what? What was the beginning balance?
15.
So beginning balance was not 15,000, 75,000. And we know, what was the beginning balance of capital? 75,000, right?
Right.
And then what do we add? Which is net income. And we also subtract what?
Withdrawals. 20.
And we subtract withdrawals of 20,000. So our new capital balance should be what? I'm gonna give you a chance to either write it, take a picture of it, or whatever works best for you.
I gotta watch that.
You guys writing this or you have it? Or you good? You got it? You sure? Got it? Miss Harris, you got it? So that's just saying the same thing, that's what this is going through. Post-closing trial balance. So after we've closed out did those closing entries. Now all we have left are what type of accounts?
Liabilities, assets, and ownership.
So the permanent assets, liabilities, and capital is the only equity account you have left. So once you do that, you have to do a trial balance again, which is called the post-closing trial balance. And then you also have to do, what else?
An adjustment.
Possible adjustment, maybe. So this is basically what a post-closing trial balance would look like. Notice you don't have any revenues, any expenses, right? Just assets, which stop here, then liabilities, and then capital. And that's ultimately the goal after you do the closing entries. So this is the accounting cycle you've been going through for chapters. You started off in chapters 1 and 2 analyzing, right? And then journalizing them in a general journal, then posting them to the general ledger. And then in chapter 3, you prepare unadjusted trial balance. You made adjusting entries. And then you got here to part 6, where it says prepare an adjusted trial balance. You've learned how to prepare financial statements, do closing entries, which is step 8, and then prepare a post-closing trial balance. And sometimes, on the rare occasions, some journal entries might have to be reversed. And that's very rare. Typically doesn't happen. It won't for sure be on your test, so don't worry about that. But in rare occasions, the last step may be to reverse. So of course, if you have to do some reversing entries, what step do you think you have to go all the way back to? Now, step 1.
Step 3. Change.
Reversing entries can be the same as adjusting, which means you got to go back and do an adjusted trial balance and prepare financial statements, right? And then do closing entries all over again, and then do a post-closing trial balance. But that's very minimal. So classify balance sheet, something else you need to know. On the balance sheet, we classify assets and liabilities as current and non-current. So if it's a current asset, that means it could be liquidated, it could be sold, it could be disposed of within 12 months or within the accounting period. If it's a current asset. If it is a non-current asset, that means that the disposal period or liquidation period is beyond 12 months. So some current assets, cash, obviously, accounts receivable, right? Supplies, those that's highly liquid assets. Long-term or non-current assets would be things what we like to call PPE or plant, property, and equipment. Your buildings, your land, things like that. They're going to extend beyond 12 months, right? Intangible. Intangible means it's an asset that we own. We can't physically touch it, but we know that it exists. So things like patents, copyrights, trademarks, those are still assets. They're just not physical, can be touched, right? But they still hold value. And then current liabilities would be liabilities that we can reasonably pay off within the next 12 months versus non-current liabilities, which would take us much longer to pay off beyond 12 months. So that's just explaining what I just said. They're expected to be sold, collected, or used within 1 year.
So this is an additional balance sheet that we have
It's
to
the
do.
same balance sheet, you're just breaking it down instead of just saying assets and liabilities. You're saying current assets, non-current, current liabilities, non-current liabilities. Same thing, just breaking it down a little further. And that's just going through the same thing that I just explained. And so this is an adjusted trial balance, right? Not necessarily classified. This is the one that you've seen before. But if we had to classify it, we would classify that our current assets are cash and accounts receivable. Our long-term or non-current assets are land. current liabilities, accounts payable, long-term or non-current liabilities will be long-term notes payable. Because these things extend beyond 1 year. So what I want you to do right now